Are we out of the woods?
Well, I think what we've seen is, first of all, I think the Fed's reaction quickly in backstopping depositors came right out of a playbook they had in 2008, right? Like, they figured it out, took them time there. They knew what they needed to do, and I think they've proven that they're willing to respond quickly. And once you can calm down the confidence, because it becomes a question about people's confidence on these banks, it makes a big difference. And let's remember, this isn't credit quality issues. This is duration, right? So these are, these are solid investments that were long duration that got impacted by very quick interest rate climbs.
Markets seem to have reacted like this is some sort of looming crisis. Is this really a crisis in your eyes?
Well, I do think, when you see people now calculating the numbers of the embedded losses in held-to-maturity portfolios and available for sale, and that raised a concern. The reality is those aren't realized unless the depositors flee, right? And so these types of programs calm the depositors stay there, and you don't realize the losses, and then you're not worried about the hit to capital. And I do think Sally pointed out, which is exactly right, you had this fleeing of depositors into the big banks, so now they've invested back. It is kind of full circle, and I think that is a very elegant solution.
Does this, in many ways, and I'm going to tie in really the investing environment here, challenging year in 2022, does this in some way pull forward the end of the tightening cycle in some way? Even though the Fed probably has maybe one or two still in the bag? I
mean, I think that's a great question. I think the Fed is threading a needle here because, on the one hand, any kind of increase above about what the market thinks at 25% causes more, on paper losses for the banks, which then becomes greater risk. The other side of this is if you actually looked at the core inflation numbers, so headline inflation was down because energy was down, kind of healthcare was down, but actually, things like airline, apparel, eating out, hotels, those actually increased a bit. So the consumer is still strong in spending. I think bringing inflation from 9 to 5 is the easy part. 5 to 2 is going to prove much more challenging. And so I don't think we're out of the woods yet on that.
In terms of the markets, then, what have conversations with clients been like this week for you? Do you think bonds are finally going to settle down, or could this actually start spiraling out in other assets too?
Well, I think the intervention that's happened is an attempt to try to settle things down. So, and I think it is effective. So we should see some settling down. But it's obviously the geopolitical environment is such that we're living in a time of volatility. Now, I say as active managers, that's a good thing in the sense that volatility actually allows active managers to show their skill.
We're showing this on screen, money markets 5%, and I'm wondering what you're seeing as far as flows are concerned, because cash strategies did very, very well. Are still doing well?
So
how do we nuance that?
We've seen an influx of a lot of cash coming into money market funds. Right now there's some question about whether or not people are concerned about money market funds as if they're a checking account. So different. Money market funds are completely restructured from the financial crisis. It's a great place to be, which I also think is one of the challenges, right? People look at their bank account and maybe they make 1.5% interest, or they can move it to a money market fund and earn 5%. And I think that's just, over time, those things come much closer together. But right now, because of the pace of change, that's just been a lag.
How investable do you think financials are at the moment?
Yeah.
Well, I think selective financials. I think people are, going to be measured, and they're going to do these calculations around what are the embedded losses and even the held for maturity portion of the portfolios, and they'll make decisions. But I think anytime an entire sector goes down, you can find opportunities.
Do you guys still have any exposure to SVB or friends?
We had very little exposure. I don't know the answer to that right now. I mean, I think we had our venture fund had small deposit there.
Okay.
So I'm sure it's probably,
Yeah.
Well, if it's not worrying you, it's probably not that.
Yeah. It's not material. How's that? It's
Why do you think regulators, the Fed, Treasury, the like, were so quick to respond to this? Even with some of these big banks stepping in when it comes to First Republic as well. Is there an issue of moral hazard here in the long term that we have to worry about?
I think we have learned that you need to calm the markets in these. Otherwise, there's a domino effect where even good banks get swept into it, and that becomes a major crisis. So if you can address the issue early on, then you can calm the markets, and I think that's what they understood they needed to do.
And just back to what you're seeing from your perspective as far as flows are concerned there. I mean, has there been any pickup in other strategies, for example? You talked about cash strategies.
Look, you look at what the market has done. As interest rates came back down, suddenly growth stocks and tech stocks went back up yesterday. Other parts of the market got killed. What we've seen is a flight to quality, shorter duration on the fixed income as people are trying to wait to figure out when the top of this cycle is. You're starting to see areas, actually emerging markets. The dollar's been very strong, so there's a lot of people who feel like when the Fed gets to the top of their rate increase, that the dollar's going to turn, and that'll also bring some other international opportunities.
I was going to ask too. I mean, Treasury yields have come down substantially. Do you think even if the Fed has a little bit more to go, do you think we've seen the top in yields already? Do you think the top's in?
I think the Fed, as I mentioned, I think that some of the core inflation numbers are still pretty inflationary. I mean, you saw things like even in the UK where they just had a settlement with the unions on I think it's next year, a 5% increase in wages. Those types of decisions are inflationary. So I think that we haven't, while we're all worried about whether it ultimately turns into and when there's a recession, I think they still haven't quite manage to cool it off quite enough. So, I think we could see another 25. Will it be in March? I'd be surprised if they didn't do 25 in March, because suddenly you'd have to catch up again. And all of any kind of losses associated to an increase in portfolios is already baked in because the market's expecting that. And then probably another 25 at least.
Jenny, I was going to ask you, it's the first time in 5 years that you've been in Hong Kong. And so it's certainly a rare opportunity to get your perspective on just what we've been seeing, these geopolitical tensions between the U.S. and China. How are some of these kind of big institutional allocators, the pensions, the endowments, how are they looking at China now? Are they investing differently?
So what you see that U.S. pensions are underweight China. And actually what you see is regionally in Asia, they tend to be overweight China. There's almost a little bit of retrenching back into your kind of near-term, market. Franklin Templeton has clients in 160 countries. So we have a good perspective on all of, kind of where those flows are. But that's what we're seeing right now.
Okay. And certainly this flow back into your comfort zones, I think, is what you're alluding to there,
I think
right?
So.
You're going back into your market. Do you think there's a disconnect there? Because when you talk to people here, there's very little wrong with what's happening in China. You talk to people outside, it seems like the complete opposite. Like, there's probably the middle ground there.
Yeah, look, I think, we've all been talking about there's going to be 1 billion people who enter the middle class in the next decade, and 87% of them are in Asia, and China is a big part of that. So I think there's a lot of growth opportunities here. I think that people are nervous with the geopolitical environment and the tension and the rhetoric in the U.S., and so that makes investors nervous.
Opportunities here. What's your plan around headcount in the region? Are you hiring?
We've actually been growing in Hong Kong. I mean, in the region, definitely.
Elsewhere, yeah.
But even in Hong Kong, we had an increase in headcount. We've been in Hong Kong since 1987, by the way.
Okay, longer than me.
Has anything changed since the pandemic, though? I mean, there was this whole kind of exodus of bankers that left Hong Kong when things were shut down or locked down. Has any of that kind of changed where you allocate where jobs are now?
Look, it's an important market, and so we're here. We're in Singapore. I mean, we're in most every market in Asia, any sizable market, and we've been in those markets for 20 plus years. Singapore has also grown for us.
I guess, is there a deliberate sort of conscious effort that Singapore perhaps deserves a slightly bigger allocation now, just given geopolitical risks, what have you,
Honestly,
or what's happened here in Hong Kong the last 12 months or so, or 18 months?
We don't really think about it that way. You're thinking about where your clients are and how they want to be served, and then where you can get your investment talent, right? And so we tend to be, and I think this is what the work from home has helped do, is you realize you can be much more flexible about people's locations. So you go where talent wants to be.
I was going to ask you about India. There's been some reports, maybe you can clarify for us, about operations there. Can you tell us about that, and how important is this market to you?
Look, India is an important market. 56% of a population of 1.3 billion is under the age of 25, so it's a really important growing market. We ran into trouble in some of our fixed income products back right in the pandemic when you basically had liquidity dry up. And we made a really tough decision to shut down 6 funds.
Yep.
And we've now gone through the process and have paid 107% of that. So all 6 of the funds actually have a value greater than when we shut them down. Our alternative was you leave them open and you end up selling to meet redemptions at great discounts. And we were worried about the first out, we're going to get decent prices, and after that, those who remained would get distressed prices. And it was a really painful process. It was painful for our clients, but in the end, we think it was the right decision.
Okay, and has that been resolved? I mean, 6 funds, 5 out of the 6.
So 4 of them have completely paid out.
Okay.
2 of them, as I said, they all have a higher value than the day.
Yeah.
I think one of them has 98% of the remaining that's been paid out and has some illiquid holdings that we're working through.
Okay.
And the other's been 104% with a few illiquid holdings that we're waiting to mature.